Good evening, everybody. My name is Dominique Monayong Jr. Today, I'll be presenting my research for C772, the Analytics Graduate Capstone, and the title of the research um, is called Statistical Analysis of the Impact of the New Jobs Act. So for today, I will discuss the following topics in the following order. So first, I will give a brief introduction about myself, and then I will discuss the problems as well as the hypothesis of the research. Then I will go into the data analysis process used. Then I will discuss some of the findings, the limitations, the proposed actions, and expected benefits from this research. So, brief introduction about myself. I'm currently a business system analyst working in the financial regulatory industry. I have 3 years of experience within the field, and I received a BS in information science with a concentration in economics from the University of Pittsburgh in 2015. So there's three background terms that I think are important to know to give a bit of context for the research. The first term to know is tax credit. So some of you might be familiar with tax credits, which sometimes are very useful around tax season, which is April April 15th for U.S. residents. So tax credits refer to an amount of money that taxpayers can subtract from taxes owed to their government. Unlike deductions and exemptions, which reduce the amount of taxable income, tax credits reduce the actual amount of tax owed. So later on, I'll actually show a brief example of how tax credits can be used to reduce the amount of tax owed to the government. Two other terms that are important to understand are expired tax credits, which refer to credits that have not been used within a specific time frame mandated for the credit. So some situations when there is a tax credit, if you want to use this tax credit to deduct or reduce the amount of taxes owed, sometimes can be a specified time frame. It could be 1 year, it could be 5 years. But if you don't use the tax credit within that time frame, then you're not able to apply it to reduce your taxes. And then the third term is carry forward tax credits, which refers to credits that taxpayers choose to apply in a later tax year. Simply put, for different situations, the tax applicants actually might decide to defer, and instead of using the tax credits in the current tax year, they might choose to use it in a later tax year. So if you, for instance, thought that maybe next year you're going to have a very high tax liability, which means that the amount of money that you're going to owe next year is going to increase significantly, you might choose to use these carry forward tax credits in order to reduce your liability when it counts. So a brief example to understand tax credits, or to better illustrate tax credits, is we're going to take two pizza shops. Jacob's Pizza Shop, this is without any tax credits. So Jacob's Pizza Shop, after all of his business, he owes the U.S. government $10,000, which he must pay for his taxes. Whereas John's Pizza Shop is able to actually reduce his tax liability by using tax credits. So in this example, both owed originally $10,000, but for instance, let's say that the local government is giving a tax credit for any businesses that install solar panels in order to improve energy efficiency. And let's just say that the tax credit that they give John's Pizza Shop as the owner of the business is $5,000. So as a result, John's Pizza Shop, when they actually have to pay their taxes, instead of paying that $10,000, they actually will pay the $5,000. And sometimes tax credits can be used to actually incentivize good behavior within a society. So in this example, a local town might decide that they want to encourage people to use more energy efficient appliances or more energy efficient or better energy efficient resources. So the problem to be discussed is between January 2000 and December 2014, the United States lost 5 million manufacturing jobs. In 2014, there were 12 million manufacturing jobs within the United States. So to give a bit of context, Between between 2000 and 2014, there was 5 million manufacturing jobs, which is roughly almost half of the total manufacturing jobs um, at in 2014, according to the Bureau of Labor Statistics. So, in many states, the manufacturing sector represents a substantial portion of their economic growth. For one example, Iowa, 88% of their exports comes from the advanced manufacturing sector. So this puts Iowa in an interesting position where changes in labor costs or automation could drastically diminish a region's future economic growth. To give a bit of context, let's use this Ford truck as an example. Let's say that this Ford truck typically is sold at $5,000, and it cost Ford $1,000 to make this Ford truck. That would mean that when Ford actually sells this truck, they are actually profiting of $4,000. Now, let's say that instead of this Ford truck costing $1,000, because let's say the price to make tires and to make the body of the car actually goes up to $3,500. Now, instead of a $4,000 profit, Ford is actually going to see a $1,500 profit, which is actually drastically significant. And in some actual companies, the margins are very, very slim. So any changes in labor costs can actually drastically impact the company. As well as automation plays a factor in the economic growth of a community as well as a company. So as automation continues to grow, certain jobs done by humans are no longer needed. This can lead to the potential that some companies will actually choose to lay off many of their workers. Some states have recognized this problem and have decided to take a more proactive approach by offering tax incentives to employers who develop training programs. Training programs allow individuals who would be displaced to gain new skills and start a new career. So you could think of using the Ford example that was brought up earlier. If there is let's just say there's an automation line or manufacturing line to build a car, there might be several employees who have skills that those skills will no longer be needed because they will be replaced by automation, but they still have skills, and some of these skills can be retained, and an employer might decide to retrain these individuals in order to allow them to start a new career, as well as sometimes even hire people outside of their current company. So this is a benefit not only to people outside the company, but also for people within the company, as it kind of helps to reduce the cost of having to retrain and rehire when you have these tax incentives, which make it more or less free for the employer. So the hypothesis is that job retraining tax incentives have a significant positive impact on economic improvement in metropolitan regions. So there are three data sources which were used for this research. The first data source was the Iowa Current Employment Statistics, which provides a monthly employment numbers by sector and metropolitan area. The second is the New Jobs Tax Credit Claims, which contains information on tax credit claims reported in Iowa between 2006 and 2012 by county. This includes data such as the adjusted gross income of the tax applicant applying for the credit, as well as information such as how much did the applicant use in tax credits that year versus how much did they carry forward and how much expired. And lastly, an interesting point just to point out is that 25% of the claims made occurred within the metropolitan region, which means that 75% of the claims actually occur in the non-metropolitan region, which is actually very significant. And then the local area unemployment statistics was the last data set used, which includes annual information on unemployment and labor force data. So for the analysis, I started off with conducting a series of exploratory summary and analytics. So the first question that I was interested in kind of understanding, let me go back, sorry about that. The first question that I was kind of curious to understand was, well, how many people are actually making claims, and which adjusted gross income group, which will be referred to as AGI throughout the presentation. were actually were claiming to use the tax incentives. So as we could see, the 200,000 to 999,999, so roughly 1 million, that adjusted gross income group actually had the highest amount of claims. And we can see actually that the individuals or businesses that have a adjusted gross income of less than 20,000 actually had some of the lowest amount of claims applied for over the course of the 6 year span. So there's one additional formula which is really important to understand for context as I continue to go through this presentation, which is the net gain. So as we've described some of these terms earlier, the net gain helps to give a better understanding of the overall gain that an applicant, which can be an individual or employer, gain from using tax credits. So to calculate the net gain, I added the amount applied, which is the amount of tax credits the applicant uses within a current year, with the carry forward amount, the amount of tax credits that the applicant decides to use in a future tax season, minus the expired tax credits, which are tax credits that they no longer can use. And this is just used to get a better understanding of the overall claim. So the net gain by adjusted gross income group actually shows how much did each group overall benefit from each tax claim. So as we can see, even though the $1 million and more AGI group actually what didn't have the highest amount of claims, this group actually benefited the most by saving roughly over $6 million in tax credits. One point that was actually fairly interesting to me was that the less than 20,000 group, which actually, if we were to go back, actually had some of the fewest tax claims made, actually has the third highest net gain of all the different groups, which is actually pretty interesting because typically when there are tax incentives, there can be some sort of there can be a sentiment that only the highly rich are the ones who benefit from the tax credits. But in this case, it's actually interesting to find that those who make less than $20,000 are actually in that group. Actually, was the third highest and was able to utilize these tax credits, which means that it's reaching all businesses and individuals of different income levels. So I wanted to further explore the numbers that were looked at earlier. And so I organized this data by the AGI group, and I wanted to understand what was the max amount of tax credits applied by one claim, as well as the average amount applied, and the same was done for carry forward. So what's interesting to notice is that the $1 million or more AGI group, on average, saved about $12,000 per claim, but there's actually some of the individuals or businesses who actually saved significant amounts of money. One actual group was able to save over $635,000 in one tax season by retraining employees. And then what's another interesting point is if we look at the less than 20,000 group, which was the last group, or the last row, we see that there's actually the max amount that was carried forward was $518,000, or roughly $518,000, which is a significant amount of money for a company that has less than $20,000 as their adjusted gross income, which is really interesting to see that they are able to use this money down the road in future tax seasons. So the next item that I wanted to take a look at was to understand the overall net gain by year. So as we could see, starting from around 2006 to 2007, taxpayers within Iowa are actually saving roughly $2 million or more per year. But as we look from 2007 to 2010, there's actually an extreme dip in the amount of tax savings, which can partially, but mainly probably be contributed to the subprime mortgage crisis, which can be defined from starting a little bit before 2007, but 2006 to roughly the 2010 period. But we can see after that period of 2010, which can also be contributed to other legislation. We can see that the amount of money that the taxpayers were able to save actually goes back to fairly like normal rates of roughly $2 million per year. The next part of the data analysis process was to actually look for correlation and to identify patterns and relationships amongst some of the different variables. So for the correlations, I looked at primarily some of the tax incentive variables, such as the carry forward amount, expired amount applied, and these items were examined to see if there was any patterns or correlations with the job growth, the overall job growth, as well as the job growth by job sector. So in this example, we can actually see that we're seeing that the carry forward amount applied and workforce don't show by any means any strong correlation, as well as the other correlation or the remaining scatter plots that were shown. And that was very consistent with all of the other job sectors as well. So while there is a somewhat of a positive correlation, you can see that the carry forward amount does increase, the workforce does increase somewhat as well, but there's no clear correlation that can be identified by looking at the scatter plots. And another item to note is that the expired values actually show roughly zero across the board, minus with a few exceptions, as the workforce increases, which is actually really good to see because that means that the taxpayers and applicants who are using the new jobs tax credit, they're actually not allowing their tax credit to expire and they're actually using it within a tax year. So then I went and developed several multiple linear regression models. I used the stepwise selection method. And then for my criterion, I used the corrected attributes information criterion. And I used this criterion mainly because of the small sample size. So I wanted to be able to account for the biases within the data. So in this example regression model, there were several of the the tax incentive related variables which were used to predict job growth for the goods producing sector. So in this model, the two variables which were selected were the net gain, which is the overall benefit to the taxpayer, as well as the unemployment rate. And in this model, roughly 68% of the variance could be attributed based on this model. And if we look at the bottom, both of the variables, the net gain and the unemployed, their p-values both are lower than 0.05. So we would not reject them. Now, when we actually looked at the diagnostic plots, we saw a slightly different story. So as we can see, the QQ plot, the residuals actually line up pretty closely with the actual line, with the plotted line, which is what we would like to see. And the residuals in the bottom left plot actually show somewhat of a normal distribution. But as we can see in the top left corner, the encircled plot, the residual plot actually does not show constant variance. As a result, this issue actually violates one of the one of the linear regression assumptions, which is that all of the residuals will have constant variance. So the findings for this research indicated that there's not significant evidence that job retraining tax incentives positively impact the metropolitan region. So with all of the linear regression models that were developed, all of the models failed to meet the assumption of constant variance within the data. Some interesting findings of the research was that the $1 million and more AGI group financially benefited the most from the tax credits by saving over $6 million US. The less than $20,000 AGI group applied for the fewest tax claims, but had the third highest net gain of all categories, as shown earlier. And that's good. That's always good to see, as that's an indicator that lower income individuals or businesses are able to also benefit from these tax credits. Some of the limitations of this research include the impact of the financial crisis on the data is unknown. The model does not take into consideration the demographics of the region. So, for instance, if the population is an aging population, I think that would have been an interesting variable to have considered um, versus a much more younger population or more transient population. Also, other variables such as the wealth of the area were not considered. So I think that could have been used to kind of get a better understanding, to get a better understanding of what type of areas were actually, what type of regions are benefiting the most from tax credits. Also, additional variables such as foreclosure rates or spending consumptions could have been utilized to understand the impact of tax credits, rather than using simply just the workforce numbers. For the proposed action summary, so 75% of the tax claims in Iowa filed between 2006 and 2012 occurred in the non-metropolitan regions. These claims should be researched for developing future models to get an understanding of how rural areas benefit from the tax credits. I think this is pretty important, considering that the majority of the claims come from the non-metropolitan region. This could actually give a lot of insight into understanding who's being able to actually benefit from these tax credits, which leads to the second point, which is there should be further research conducted to understand the profile of individuals claiming tax credits outside of their adjusted gross income. I think this would be very important because the adjusted gross income, for instance, one of the groups shown earlier ranges from $200,000 to $999,999, which is close to $1 million, and that's a very wide AGI difference of roughly $800,000, and I think that those groups probably might have different needs as well as different problems. So I think understanding the profiles of those individuals would be beneficial. And lastly, the benefits of this research is I think this research allows those who are interested in local government and economic development, particularly in local government, to kind of get a better understanding to gain some preliminary insight into the impact of tax credits within metropolitan regions. So from this research, we're able to understand that employers saved $11.3 million by retraining new employees from 2006 to 2012. 56% of the beneficiaries were individuals or businesses with an adjusted gross income less than $200,000. And future researchers can use this research to identify which variables to not include or to consider adding to the model. And I think this will be a benefit to as this research can be used as a starting point for those who are interested in this field. And then I've added the references that I used here. Thank you, and if you have any questions, please feel free to email me. My email will be included with the capstone.